On the Money, powered by Ally Wealth, folks. Ryan bringing us back in from the segment. Spike's not taking the day off or not doing his job, though he's being quiet for a change, right? But anyway, so, I'm coming back in because we left talking about the Dave Chappelle skit, Spike, where
I think he was talking about Trump and taxes, right?
Yeah, it was the Trump-Clinton election, 16, I believe, and Trump says something like, I know about the tax system because I've used it. You guys made the tax system the way it is, and I use it, right? And it's a joke. And by the way, I believe Dave Chappelle, greatest comedian of all times. I mean, the heavyweight championship belt of comedy is most certainly around his waist. And I miss the old days, when we weren't so politically correct as a society, to where we could do the Rick James skits. I'm Rick James, so good, bud. But anyway, so here's where I'm going with that, Spike, because, we're talking about if I'm going to pay less taxes as a business owner and I am in growth mode in my business, which I clearly am, the more money I keep, the more money I can invest in my business, the more people I can hire, and the more I can grow. Well, the more people I hire, it creates a tax base. The more money I make, it creates additional tax base from the employees that I bring on and new advisors, and new locations that we build, and that sort of thing. So it's actually accretive to the IRS, right, or to the bottom line for the government. But one of the things I think people have don't have a clear understanding on is this. They say, okay, the wealthy need to pay their fair share. Okay, well, let's put that in perspective. Let's say I sell my business for $10 million. Okay? That's a big number. That's a lot of money. And certainly somebody with that kind of money is a wealthy person by far. All right? Well, what's going to happen is I'm going to pay capital gains tax on the sale of that business. All right? And I'm also going to pay a 3.8% net investment income tax. So I'm going to pay 23.8% in taxes when I sell that business. Okay? Now, let's just assume that I walk away from the closing table with $8 million. All right? Well, that $8 million, I turn around and invest in tax-free municipal bonds. And guess what? I don't pay any income taxes, right? Because I'm investing in tax-free municipal bonds. If I invest in stocks and I sell a stock within 12 months and 1 day, I qualify for capital gains tax treatments, right? Because I've already paid tax on my money. And so I think there's a big disconnect with folks because wages are different than money you've paid tax on. Your wages will always be taxed at ordinary income tax rates. And if you have a substantial amount of wealth, you can position your money in a way to only pay capital gains tax rates, which are less in most cases than ordinary income tax rates. And you can also position your money in a lot of tax-free things like tax-free municipal bonds, which is a good thing because that helps schools and municipalities grow and that sort of thing. But it's just interesting to me about this, this kind of attack on, pay your fair share. I believe in paying my fair share of taxes for sure, but there's just the way the tax system works. I think there's kind of a misunderstanding about some of that stuff, and it's important to clear up.
Right. It's confusing, I think, to the regular consumer.
For sure.
And I think most folks, even in their 50s and 60s, they probably go into their CPA and say, I want to pay as little in taxes as possible. That's pretty much been the mantra for the last 4.5 decades. Of course, corporations want to do the same thing as well. They want to be able to pay as little in taxes. And there's also R&D. There's reinvestment into opening up new locations or product or hiring new people. I just think that it's so confusing in the tax code that the regular consumer is like, are we having to pay more than everybody else? Or because it just feels like it. There's just a lot of heavy tax out there. But that's exactly why you try to help people get into some tax-free lanes as well. Can you discuss, are we still talking Roth conversion right now? Are we still talking about saving tax deferred, or do we need to get away from that right now?
What compounds the problem, I believe, is we're taught when we work for a company to put money into our 401k. When we put that money in that 401k, we do it out of our paycheck. We don't see it. And guess what? That money is not taxed. Then your employer hopefully adds in a match, All right. So that money goes in. It's not taxed. And then over time, you're investing in the stock market, and hopefully when you started your career at, 25 maybe, and you retire at 65 or whenever you retire at 40-year period, your money has grown substantially in the stock market. Well, guess what? You paid no growth on the you paid no tax on the growth. Okay? So you've had contributions tax-free. You've had match tax-free. You've had growth tax-free. And now once you retire, every dollar you pull out of those accounts via distributions for income to finance your retirement lifestyle, 100% of those dollars are taxable at ordinary income tax rates, which, by the way, are the most expensive tax rates. All right? So, when it comes to solving problems for people that are retirement minded, which that's what we do here at Allied Wealth, one of the biggest things we have to overcome is reducing taxes in retirement. Because if I can reduce your taxes by several hundreds of thousands of dollars over the course of retirement, that helps your money go a lot further in life. You could do more things, all right? So one of the ways that we can do that, Spike, is doing Roth IRA conversions. And there's a whole, conversation of, should I do that while I'm working, or should I do that after I retire, my income's lower? Everybody's different. Mathematically, there is a solution for you, okay? And we can certainly help you identify what that looks like for you, all right? But you can also fight it a different way. And what I mean by that is, don't let your composition of accounts be so lopsided towards what we call tax-infested retirement accounts. Have a balance of money in IRAs and 401ks, no problem, okay? Have a balance of money in Roth IRAs, and have a balance of money in after-tax, non-retirement account type money. So there's a lot of different avenues you can do to cut taxes in your golden years, but you can either do Roth conversions or focus on the composition of your accounts being in a way to where you're not so lopsided and every dollar you're spending in retirement is 100% taxable.
Ryan, we're going to take a very short break right now. Call that phone number, 844-944-7555. You can get started on your own financial flight plan from Ryan Wheelis and the team at Allied Wealth. If you're listening to us on the radio, we have so many other tools as well. You can go to retirenowhouston.com. That's retirenowhouston.com. You also have the tax bill calculator there. You can go to the YouTube channel, and I've just found, Ryan, the easiest way to find it. It's actually, if you just type out On the Money 1, inside of YouTube, it takes you right to Ryan Wheelis. On the Money, the one number, that takes you right to the YouTube page where you see, I think we've got now 160, 170 or something videos.
Sure,
yeah, we're getting up there. More Ryan Wheelis and On the Money from Allied Wealth right after this.